Welcome to the speed review of the CFP exam. The goal of this session is to warm up your memory and get your brain cells firing. No teaching, no problem walkthroughs, just pure facts washing over you for 90 straight minutes. This is a great one to listen to if you've done a full review and you're juggling everything in your mind. Or it's the night before the exam and you're looking for a confidence boost. To that end, take what you want and leave what you want. If I say something confusing or that conflicts with your prep provider, go with your prep provider. The goal here is to activate muscle memory and confidence, not to send you into a panic. We're going to cover all 8 domains on the exam, with minutes roughly allocated by exam weight. Sure, estate planning could be its own half day, but we're going to try to cover a lot of ground in just 12 minutes. All right, let's get started. So much of the CFP exam is about what professionals do. This section is about how it's done. CFP professionals mainly interact with 3 groups of people: clients, colleagues at their firms, and the CFP board. The code and standards provide guidance on working with each. Let's start with duties to the clients. These can be further broken down into duties in all interactions, including with prospects and the general public, duties when providing financial advice, and duties when providing financial planning. Now, there are 11 ever-present duties. We are just going to talk about the less obvious ones. Diligence, don't drop the ball. Competence, having the necessary skills and knowledge. If you don't have it, pull in a colleague, refer out to a specialist. Do not pretend to be an estate planning lawyer or a niche tax professional, even if you're using Google or special software. Duties when representing compensation. To be fee only, you and your firm must be receiving exactly 0 commissions. That includes no trailing commissions. Confidentiality, confidentiality, confidentiality. Make sure you know who your client is. Don't talk to their child, their parent, their accountant, their lawyer, their father's best friend's uncle, unless you have their express permission. Power of attorney is a type of permission, so is naming someone a trustee. Moving on to duties when providing financial advice. All those other duties still apply, plus more. The big one being fiduciary duty. Remember, you are a fiduciary even when giving financial advice. It's not just for planning. What is the fiduciary duty? Well, it's composed of loyalty, so putting the client first, care, caring about the specific details of your client's goals, risk tolerance, financial circumstances, basically caring that they're a real person, and directions. So long as what the client is asking you to do is within the realm of engagement and it doesn't break the law, you got to do it, even if it goes against your recommendations, even if they're backstabbing a spouse. Once you're in the advice-giving game, you also need to disclose material conflicts of interest. These are things that a reasonable person would think might put you or your firm's interest against the client's. Referral fees come up a lot in this context. It is okay to receive a referral fee. You can refer a client to a friend. Just be sure to disclose. Always let the client know about material conflicts before related recommendations. Besides conflicts of interest, there are a host of information you need to disclose to clients. What service you're providing, how the client will be paying, how you and your firm and related parties are compensated, privacy policy, public discipline, and bankruptcies. In giving advice, all of these disclosures, except for privacy policy, can be given verbally. Privacy policy must always be written. This flips when we get to financial planning, where the standards are higher. Everything needs to be in writing, except for material conflicts of interest, which can always be given verbally. Now, when you do find yourself in a planning engagement, all of the ever-present duties apply, the advice duties apply, plus now you need to follow the financial planning process laid out by the CFP board. Document the scope of your financial planning engagement. Refer back to the document if you and your client disagree. And those are the duties to the client. Now, let's quickly touch on duties to firm and subordinates. Basically, it's be a good manager, be a good team member, tell your boss when the board slaps you with a notice of public discipline. Which brings us to the board. Your duties boil down to 2 things. Don't make the profession look bad, and if you do, by committing a felony, getting in trouble with drugs, alcohol, stealing, money mismanagement, bankruptcy of you or a business where you're a control person, tell the board. In fact, if that is an answer choice to a question, it is most likely the right answer. Self-report to the board within 30 days. Provide a detailed written narrative. Failure to do so is a cause for discipline in and of itself. Self-reporting is not the only way the board becomes aware of potential infractions. A client may file a complaint, for example. The board will then issue you a notice of investigation. You need to acknowledge the receipt of this notice within 14 days and cooperate with the investigation. In this preliminary phase, there are a few potential outcomes from least to most severe. No probable cause, basically a dismissal. The board issues you a letter of caution. You and the board mutually come to a settlement offer, or the formal process continues into a full-blown complaint. This is where things get real. You may, but not always, have your certification and use of the marks temporarily suspended. If they are, you must immediately stop using the marks in marketing and other materials. The Discipline and Ethics Commission, DEC, they run the process. They're a volunteer group of CFP professionals, a jury of peers, so to speak. You may interact with a subset of them as part of a hearing. Now, the possible outcomes of a full-blown complaint include, from least to most severe, dismissal of the complaint, private censure, public censure, suspension or temporary bar for your candidate. This can be anywhere from 90 days to 5 years, permanent revocation or permanent bar of your candidate. This cannot be appealed. With public censure and suspension, you can appeal to the appeals committee. So remember, 30 days to self-report or 14 to acknowledge a notice, to 5 years for suspensions, and you must appeal to have your marks reinstated even if your suspension time lapses. All right, with those grim procedural details out of the way, let's wrap up with the actual financial planning process. There are 7 steps. 1, understanding the client's personal and financial situation. 2, identifying and selecting goals. 3, analyzing the current path and alternatives. 4, developing recommendations. 5, presenting the recommendations. 6, implementation. And 7, monitoring and adjusting. I want to call out there's a step 0, taking them from prospect to client. This includes that scope of engagement and other disclosures we talked about, as well as if you're an IAR, sharing your Form 80. Let's move on to the next domain, general principles. A lot of this ties into the steps of the financial planning process. We're going to talk about cash flow and balance sheets, both tools to quantitatively understand your client's current position, step 1, and debt management, as well as education planning, which are common goals in step 2. Finally, we're going to wrap up with econ as a transition into investments. Cash flows and balance sheets often show up in case studies. Cash flows show you how much a client is spending versus saving, and if they're digging themselves into a hole each month. Balance sheets give you their net worth, total assets minus total liabilities. For cash flow, I like to quickly scan just to see how much they're making versus how much they're spending. And for the balance sheet, I look at what kinds of debt they have and at what interest rates. More formally, the exam might ask you to assess a few things. Remember, housing, principal, interest, tax, and insurance, PITI, should be less than 28% of gross income, and total debt should be less than 36% of gross. If you're asked to recommend a debt management action, remember to check if they have enough cash or not. Make sure that they have excess cash so that they can have more money going out the door each month before trying to save them interest over the long run. Safety in general is a pretty big theme in this section. This includes emergency funds. The general guidance is 3 months if there are 2 substantial incomes, and 6 if there is only 1. Emergency funds should be kept in highly liquid assets such as market money funds and high yield savings accounts. Safety also comes up when recommending a first course of action. Generally, the board wants to make sure that you are safe before making sure that the client is safe. What makes you safe? Well, are you talking to the client and not a concerned family member? And are you making a recommendation step 4, or are you actually in step 1? Assuming you are safe, keep the client safe. Make sure that kids have guardianship. Get disability insurance. You're more likely to become disabled than die. Get life insurance. Build the emergency fund. Save for retirement. Then, and only then, save for other goals and other people. This includes saving for the kids' education, which is this like weird orphan topic floating around in general principles. If you get a 3-step education question, pick the answer C, mark it, move on. Don't waste time, even if you know you can get the question right. Come back to it if you have extra time at the end of the section. If you get a two-step problem, remember, start with figuring out how much 1 year of college will cost at age 18. So PV is the current tuition. I is the rate of tuition growth. We're not focused on inflation or investment return right now. N is the years until 18, and solve for FV. That FV is what 1 year costs. Now you need 4 years. So this is another trickier TMV calculation. The number you just solved for is now PMT. We're in begin mode because tuition is due upfront. N is 4 years, and I is the real rate of return. 1 plus the investment rate of return divided by 1 plus the tuition growth rate minus 1 times 100 to get to the format that the calculator wants. Now solve for PV. That is the lump sum cost of 4 years of college when the kid is 18. In terms of actually saving for college, if the client is older and will be over 59 and a half by the time the kid starts college, a Roth IRA is a pretty attractive option. Remember, FAFSA does not include retirement savings. It only partially counts the parent's other savings, and it fully counts the student's non-retirement savings. 529s are the other popular option, typically funded with annual gift exclusions. These can be super funded with 5 years worth of annual gifts, 10 if gift splitting. File a Form 709 if you do. Also, keep the 529 under the parent's name, so it's only partially counted in the FAFSA. Some parents use EE bonds. These are also kept under the parents' names. Interest is tax-free if used for educational expenses. Coverdell's occasionally come up. These are $2,000 per year, so it doesn't make a big dent. Plus, there are phase-outs, which are on the tax tables. Finally, there are UTMAs. These are considered the student's assets, so they're fully counted against them on the FAFSA. If your client has not been saving enough for college, there are options. So lower income families have access to Pell Grants. This money does not have to be paid back, and to subsidized loans with lower interest rates. Higher income families can get access to PLUS loans, but these will not be subsidized. Finally, you're going to need to know about AOTC and lifetime learning credits. These credits coordinate, so no double dipping. Start with AOTC because it's more valuable and only available for undergrads. You get 100% deduction for the first $2,000 and 25% for the next $2,000. That's a total of $2,500 per student per year. It's partially refundable, one of the few credits that is. The lifetime learning credit is more broadly applicable, including grad school and professional training, but it is less generous. It's 20% of $10,000 for a total of $2,000 per tax return. That's per tax return, not per student. It is not refundable. Now we're going to shift gears completely and talk about econ. This is our glide path into investments. The economy goes through boom and bust cycles. In expansion, the economy is growing, consumers are spending, jobs are growing. Things hit a frenzied peak. That's when you hear words like bubble, frothy, potentially overvalued. People worry about when the down cycle will start. That's contraction. Economic activity decreases, resulting in less production and fewer jobs. Finally, the economy hits its low point, the trough, and it starts all over again. The government, it tries to modulate these ups and downs through fiscal and monetary policy. I wish fiscal, F, went with Federal Reserve, but it does not. Fiscal policy is all the stuff that Congress can do. Taxes, tariffs, government spending. Don't get confused by this current point in history. Fiscal policy is set by Congress. Monetary policy, on the other hand, is in the realm of the Federal Reserve. When the economy is heating up too quickly and they're worried about inflation, the Fed can tighten monetary policy. They raise interest rates, making it more expensive to spend money, or they take money out of the system by requiring banks to hold more in reserves or by selling treasuries. When the economy is cooling, the Fed does the opposite. It loosens monetary policy. Now, while we're talking about the Fed, let's quickly run through some regulatory knowledge. The Security and Exchange Act of 1933 was the first. It requires full disclosure of material information for IPOs. This is the Truth in Securities Law. The Securities and Exchange Act of 1934 was the second, so it regulates the secondary markets and establishes the SEC. The SEC is a government agency who oversees all security markets. Their job is to protect investors and enforce security laws. FINRA, on the other hand, is a self-regulatory organization. It's a peer group of broker-dealers and their representatives. Their primary focus is on their members, registration, and licensing. All right, we've moved into investment planning. We'll start with the types of risk, where the different asset classes fall on that risk spectrum. Next, we'll walk through details of bonds and stocks, including pricing and how to measure returns. And we'll talk about comparing investments and creating portfolios. Finally, we're going to go over some quick facts about options. So much about investment planning is about managing risk. Basically, the risk that an asset will return less than expected and perhaps even lose some of its principal. What is risk? Well, it's made up of systematic risk and unsystematic risk. Systematic risk are all those broad, pervasive risks that everything and everyone is exposed to. You cannot diversify out of systematic risk. Remember prime, purchasing power. So as a result of inflation, you can't purchase as much. Reinvestment rate. So money paid out in dividends cannot be reinvested at the same rate. Interest rate. The value of the asset itself decreases due to rising interest rates. Market risk. You're unlucky and the market is in a recession. Exchange rate risk. Fluctuations in exchange rate negatively impact investments in foreign currencies. Unsystematic risk, on the other hand, is specific to industries and to companies. It's the unique risk. Think about things like accounting risk, Enron, business risk, Blockbuster losing to Netflix, country or political risk, this includes regulatory risk, default risk, the chances that the company defaults on its debt, executive risk, the very real egos and faults of the people running the business, financial risk due to the company's capital structure, and I'm going to break the whole ABC pattern thing and throw in liquidity risk, the ability to quickly convert an asset into cash for a reasonable value. The more exotic the asset, the higher the liquidity risk, but even something mundane like physical gold has substantial liquidity risk. I mean, I don't know about you, but I have no idea where to go to liquidate gold bars. Now, the different broad asset classes are exposed to different kinds and amounts of risk. Cash is still risky. It has purchase power risk, but it is less risky than bonds, which are in turn less risky than equities. Even within each of these asset classes, there are tiers of risk. Corporate bonds, for example, are riskier than treasuries, and within treasuries, shorter T-bills are less risky than longer T-bonds. Actually, let's stay with bonds for a minute. These are debt instruments issued by governments or corporations. They typically offer a semi-annual, so don't forget that when doing TMV calculations, semi-annual dividend payment and a lump sum par value payment at maturity. You probably hate bonds because there are so many ways to measure their return. The coupon rate, which is the annual dividend as a percent of the bond's face value. Since most bonds pay semi-annual dividends, remember when doing TMV to account for this. Current yield, it's like the coupon rate, except for the denominator on the bottom, it uses the current price of the bond instead of the par value. Again, typically stated as an annual rate. Yield to maturity is the annual return on a bond if held to maturity. You calculate this using your calculator. The price, a negative amount, is PV. Dividends are PMT. Don't forget to adjust for annual or semi-annual. Same with N. Par, aka face value, is FV. The calculator solves for I, yield to maturity. Yield to call, similar to yield to maturity, except some bonds allow the issuer to purchase back the bond early, typically for a price larger than the face value. Issuers do this if the bond's coupon rate is significantly higher than the market interest rate, i.e., they can issue new debt at a lower cost. So, how do all of these rates relate? Some people remember YMCA, some people draw a seesaw or a triangle. I have this little chant that goes from smallest to largest, coupon, current, call, with maturity squeezed in second to last. when a bond is trading at a discount. Coupon, current, maturity, call. Now, what causes a bond to trade at a discount? Well, let's talk about bond pricing in general. This is where the dividend growth model comes in. On the formula sheet, first equation, V equals D1 divided by R minus G. Remember that D1 is the next expected dividend. So you may need to take the last paid dividend and multiply it by the growth rate G. R, rate of return, will be given, G will be as well, unless you're looking at a preferred stock, in which case G is 0. There's no growth. And yes, dividend growth rate equation can be used to value stocks as well as bonds. So we've got the bond price, but prices change. The duration of a bond is a measure of the bond's sensitivity to interest rates. The formula sheet has an equation for this, right-hand side, mid-page. Delta P divided by P is equal to negative duration times change in yield divided by 1 plus yield. This equation is a helpful reminder that bond price is inversely related to interest rates. So as rates rise, bond prices fall. As rates fall, bond prices rise. It also says that bond price is inversely related to duration. Imagine duration like the fulcrum of a seesaw. On top of the seesaw, you've got cash piles for the bond's dividends and face value payment. What would make the duration shorter, pulling the fulcrum to the left? Well, if the seesaw is shorter, aka the maturity is shorter, the duration will be shorter. Also, if the dividend payments are larger, that's going to pull the fulcrum in. So bonds with shorter maturities and longer coupons have shorter duration and are less sensitive to interest rate fluctuations. Now, this duration equation, it works for small changes in interest rates, but the relationship between bond prices and interest rates is not linear at larger magnitudes. And this is the concept of convexity. Now, luckily, most bonds are positively convex. So on both sides, as rates rise and as rates fall dramatically, the bond price is higher than our linear equation would estimate. So visually, imagine a graph where the horizontal axis is yield and the up-down axis is bond price. The duration equation on the formula sheet describes a straight line tilting downwards as you go to the right. Positive convexity is a U or smile on top of that line. All right, let's move out of bond math and talk about specific types of bonds. One of the most important category of bonds is U.S. Treasury issued bonds. These come in a range of maturity timelines. A year or shorter is referred to as T-bill. T-notes are the 2 to 10 years, and T-bonds are the longer duration 20 and 30-year bonds. What happens if you need a bond with a different timeline? Well, enter strips. These strip the coupon payment and final lump sum payments into their own individual cash flows. This way, an investor can buy a payment that is 13 years out, for example. Now, strips should not be confused with TIPS, Treasury inflation protected securities. Here, the goal is to protect the investor against inflation rates going up. This is done by adjusting the principal every 6 months. So the coupon rate is fixed, but the principal fluctuates with inflation. Another type of Treasury bond to keep in mind are those used for education. So typically, interest on treasuries are taxable on the federal level. For EE and I bonds, if they are held by the parent and cashed and used for educational expenses, the interest is tax-free. Talking about taxation, federal bonds, like we said, are tax-free, are taxed on the federal level and tax-free on the state level, while municipal bonds are tax-free on the federal level. It's a little like tit for tat. So you will find munis in a lot of high earners portfolios where saving the 32% federal income tax is a big deal. The formula sheet helps quantify this advantage. When comparing a muni against a taxable bond, use the TEY or tax equivalent yield to make sure that the yields are apples to apples. Now, we could probably spend another 10 minutes on bonds, but let's move on to equities. This broad category includes individual stocks and baskets of stocks. Generally speaking, broad indices are the most diversified and therefore less risky. Next comes large cap funds, then sectors and internationals, and finally small cap and individual stocks. The answer is almost never to recommend an individual stock. Too risky. Pricing stock is an art unto itself. On the exam, you may get a dividend growth model question. There may be a reference to using discounted cash flows, which is another method where you project the company's cash flows, so not just what's paid out to investors. This works better for companies that have no or low dividends and are investing back into the business. More commonly, you will be asked to compare and recommend an asset. In the world of investing, a fundamental goal is to maximize expected return for a given level of risk. The simplest way to measure this is using a stock's total risk or standard deviation. This quantifies how much the price fluctuates from its average return over time. A higher standard deviation indicates greater volatility and greater risk. It's helpful to remember 68, 95, 99. These are the chances that an event occurs within 1, 2, and 3 standard deviations. But not all risk is the same. Covariance is a statistical measure that shows how the returns of two different assets move in relation to one another. If two stocks have a positive covariance, they are moving in the same direction, while a negative covariance means they move in opposite directions. By adding a stock with a negative covariance, well, that's valuable because it reduces the overall portfolio risk. Diversification. Now, remember when we were talking about systematic and unsystematic risk? If standard deviation is a measure of total risk, systematic plus unsystematic, beta is a measure of just the systematic risk. It measures a stock's sensitivity to the theoretical market portfolio. A stock with a beta of 1 moves with the market. A beta greater than 1 is more volatile than the market, and a beta less than 1 is less volatile. To determine how much of a stock's movement is actually explained by the market and not by unsystematic risk, analysts use the coefficient of determination, R squared. Generally, you want an R squared of 60% or higher to use beta. Otherwise, standard deviation is a better description of the stock's risk. This all comes together in the capital assets pricing model, CAPM. That's the equation in the formula sheet that says the expected return of an asset is equal to the risk-free rate times the risk premium times beta. Now, keep an eye out on the exam if a question is going to give you the expected market return, R sub M, or the market risk premium, R sub M minus R sub F. Okay, so far we've talked a lot about theoretical return. After investment has run its course, its actual performance can be evaluating using metrics that adjust for risk. So on the formula sheet, there are 3 of these: the Treynor ratio, the Sharpe ratio, and alpha. The Treynor ratio measures excess return per unit of systematic risk, per unit of beta. Use it when the assets R squared is higher than 60%. Otherwise, use the Sharpe ratio, which is the same thing, except the denominator is total risk, standard deviation. A third measure, Jensen's alpha, directly measures an investment manager's performance by calculating the difference between the portfolio's actual return and the return that CAPM predicted. A positive alpha indicates that the manager is doing a good job. Now, are they doing a good job because of skill or luck? Well, if you are a strong believer of the efficient market hypothesis, then you think it's just luck because prices already reflect all information. So historic information, public information, private information. If that is the case, chances are you don't have an investment manager. If you believe in a moderate form of efficient market hypothesis, you think that there is some advantage to be had, particularly in private information. And if you believe in a weak form of EMH, then you think that only historical information is reflected in prices. In that case, technical analysis, reading past stock patterns, it's moot regardless. All right, so let's touch on the last topic in equities, options. Sometimes a client cannot or does not want to hold a diversified portfolio. How do you manage risk in this case? Options. When you buy, also known as go long, an option, you buy the option, but not the obligation to buy or sell a stock at a set price. If things don't go your way, at worst, you're out the premium you paid. It's asymmetric risk. If you're buying a call, you're hoping to use the call, you're hoping to call up. You want the stock's price to go up so that you can exercise your option to buy the stock at a lower strike price. When you buy a put, you're looking to put down. You exercise the put, aka sell your stock, when the market price is lower than the strike. If you're the guy on the other side of the table, well, you are selling or short the option. You must buy or sell the stock if the option holder exercises. You're betting that they don't and that you get to pocket the premium. The worst thing that can happen to you is to be an option writer and sell a naked call. This means you do not have the underlying asset that you wrote the call for. So when the stock price goes to the moon and the option holder exercises, you have to go buy the stock on the open market and pay a moonful of money. Now, on the exam, you likely won't have to do options math. It's mostly constructing positions based on a client's exposure. If you do have to do math, it'll be to calculate the option's value. Remember, an option's premium is equal to its time value plus intrinsic value, the gain you get if you exercised. Now, if exercising would result in a loss, the intrinsic value is 0. You don't exercise. Of course, there are many, many other asset classes besides bonds and equities, like property. A common measure of a property's return is its cap rate. That's its net operating income, NOI, divided by its purchase price. NOI is total rent and other revenue, like parking, minus operating expenses. Now, this does not include the mortgage or the depreciation, but it does include property tax. All right, so we ran long for investments, but let's transition into talking about retirement planning. There are many reasons that clients save and invest. Planning for retirement is a very common one. We're going to break this down into Social Security, employer-sponsored plans, including qualified and non-qualified plans, and individual retirement accounts. Now, Social Security is made up of 3 distinct benefits: OASD, old age, survivor, and disability insurance. Each has its own rules. Starting with old age, workers who are fully insured, meaning they have 40 credits, are eligible for old age benefits. The amount is based on their PIA. This is the average monthly income over the highest 35-year period, indexed for inflation with a progressive benefit formula applied. Meaning the more money you make, the less it starts to contribute to Social Security benefits. In fact, it gets capped at the wage base, a figure on the tax tables. Now, workers pay a 6.2% Social Security tax on wages up to this wage base. Employers pay another 6.2%. The other part of FICA taxes, Medicare, is 1.45% and is not capped. In total, FICA is 7.65%, or double that, 15.3%, for the self-employed. PIA is the monthly amount you would receive at full retirement age, generally about age 67. You can claim as early as 62, though, but benefits will be permanently reduced. If you claim up to 3 years early, it's a penalty of 0.05% per month. Now, you may remember the divide by 180 shortcut. It's fine. I remember 20 over 36 for 20% maximum at 36 months. If you claim even earlier, it's an additional 5/12 or another 10% over 24 months. So claiming at age 62 can result in a permanent 30% reduction in benefits. Not only that, if you are still working while claiming early, there may be temporary reductions as well. The tax tables show 2 earnings limits. The first one is for earning before the year of full retirement. Any amount in excess of the limit reduces benefits by 50%, or $1 for every $2 earned. The second is for earnings the year of FRA. It's an only 33% reduction, or $1 for every 3 earned above this higher limit. Now, old age benefits, they also apply to spouses and dependents of retirees. A spouse can claim their own old age benefit, or they may claim 50% of their spouse's PIA. Ex-spouses can also claim on their former spouse's PIA if they were married for at least 10 years and are age 62 or older. Now, if you do remarry, you lose that connection and you must use your new spouse's Social Security record. By the way, old age benefits can be delayed, so you get an additional 8% each year that you delay up to age 70. This is applied monthly, just as early claiming penalties are monthly. Okay, what about other Social Security benefits? Well, survivor benefits apply if the worker dies. The surviving spouse, if they are age 60, so a younger age, may claim benefits. If the surviving spouse is even younger and they're taking care of the deceased child who is younger than 16 or is disabled, they can still claim survivor benefits. These benefits disappear, though, when the child turns 16. The child themselves can also claim survivor benefits. These last longer. In fact, dependent children are able to receive all types of Social Security benefits based on their parents if they are age 17 or younger, or age 18 and still in high school. College does not count. If the child marries, they lose their dependent status. Note, survivor benefits are also extended to dependent parents. This is the only form of Social Security that does. Lastly, let's talk about disability Social Security insurance. This is stricter than most other disability insurance. Basically, a doctor has to certify that you cannot do any kind of work. On top of that, there is a 5-month waiting period, and there must be the expectation that you are disabled for at least 12 months. Now, this could mean that you have to wait the full 12 months and then get back pay, or if the condition is severe enough that it can be assumed that you will be disabled for more than 12 months, so say you're paralyzed, or you are expected to die. When you're on Social Security disability, your spouse and dependent children may also be eligible using the same qualifications as old age benefits. All right, all these Social Security benefits, they may be taxable. So you take 50% of the benefits and add it to your MAGI. This may include your spouse's income. And depending on how large the number is, you may be required to include 0%, 50%, or 85% of Social Security benefits in your taxable income. This does not mean it's taxed at 85%. It's taxed at your marginal tax rate. Needless to say, Social Security is a social safety net, but it is not enough for most people to maintain their lifestyles. Another major source of retirement funds is employer-sponsored plans. These can be qualified, which allows the employer to deduct contributions immediately, or non-qualified, which may still be tax advantageous, especially to the employee, though not to the employer. Qualified plans are subject to ERISA requirements. They must satisfy certain conditions in order to be eligible for immediate business deductions. These deductions are capped at 25% of total wages. Now, the requirements themselves, they try to ensure that retirement plans are available to their rank and file and not just to business owners and executives. Non-discrimination testing can be satisfied in 3 ways, each using a 70% threshold. So 70% of eligible employees, those who satisfy the 21-1 rule, are eligible for the qualified plan, or the ratio of covered non-highly compensated employees to highly compensated employees is 70% or greater, or the average benefit to NHCEs is 70% or more of the average benefit to HCEs. What is an HCE? Well, they're an employee who owns 5% or more of the company or are paid more than set amounts, found on the tax tables in the retirement plan limits and phase-out section. The other set of ERISA requirements are top-heavy testing. These use a 60% cutoff. Now, while the earlier non-discrimination testing must be corrected or the plan is disqualified, failing top-heavy testing does not disqualify the plan. Remember, key employee is top-heavy is top-up contributions, and top-speed vesting. Let's break that down. A key employee is a different definition than HCE. It's also on the tax tables right below the HCE numbers. Again, 5% ownership or higher comp. This time there's a single income limit. Now, top-up contributions, this means the plan must contribute a 3% minimum to all non-key employees. And top speed means using the 3-year cliff or the 2 to 6 year graded vesting schedule. This last part is a non-factor for DC plans, which usually uses this faster vesting schedule, but it is a big deal for DB plans, which would normally use a 5-year cliff or 3 to 7 year graded schedule. All right, let's talk about the types of qualified plans. We're going to start with pensions, which have mandatory annual employer contributions. Pensions can be split into DB and DC. There are 2 DB plans. Both are covered by PBGC insurance in case the company goes bankrupt. DB plans also require the employer to manage the investments. So if the plan falls short one year, if the company's got to make up the investment shortfall. The company is also on the hook for annual contributions. These are determined by actuaries each year based on factors like employee turnover, employee age, and macroeconomic factors. With DB, the employer takes on all the risk, investment risk, life expectancy risk, and they guarantee that the employee receives a defined monthly benefit, which can survive them to their spouse. Traditional DB plans are just that. Cash balance plans equate everything into work credits and interest credits. These help the employees have a better conceptual sense of how much money is being set aside for them. This is purely conceptual because under the hood, it's still actuaries and still a pooled investment account. Now, there are two DC pensions. Defined contribution plans in general are easier for the employer than DB plans. Employers are still on the hook to contribute a set amount. However, investment risk and longevity risk shift to the employee. So DC pensions still require an annual contribution, but now the employee has a separate account that they manage. The two types of DC pensions are target benefit and money purchase plan. Target benefit is kind of like DB Lite. Actuaries calculate a target benefit once at plan inception, and those stay untouched, no adjustments. Money purchase is the only pension that allows for employee contributions. It's kind of like a 401k in pension form. More popular are profit sharing plans. These are all defined contribution plans, meaning the employer contributes funds, but the employee is responsible for the management and for making sure that they have enough money at retirement. In fact, profit sharing plans are even better for employers because the contributions must only be substantial and reoccurring, not every year. So that's generally interpreted as 3 of the last 5 years. So an employer installing a profit sharing plan, they're doing it because they don't mind contributing, but they want flexibility. Key profit sharing plans to be aware of is the standard profit sharing plan, those with the 401k clause, which allows employees to defer pre-tax dollars, age-weighted plans, which are a special type of plan that allows for different contribution formulas based on age, and crosstab plans, which are kind of similar, but they allow you to bias contributions towards a group, this time based on role or geo instead of age. Now, when thinking through which qualified plan to recommend to a client, it's helpful to remember a couple things. DB plans tend to favor older workers with the downside of mandatory annual contributions. Age-weighted and target benefit are DC plans that favor older workers. ESOP and stock bonus plans, they allow the employer to contribute stock instead of cash. And just as likely, the correct answer will be one of these simpler retirement account options. These are not necessarily qualified accounts, but let's talk about them anyways. We're looking at SEPs, Simple IRA, and Simple 401k. Now, SEP stands for Simplified Employee Pension. As such, they do not allow employee deferrals. They are employer contribution only, like most pensions. Now, the weird thing about SEPs is actually they are IRAs, so their features are very wacky. For example, SEP contributions are limited to 25% of salary, not 100%, or the annual maximum contribution for DC plans. That's $70,000. It's on the tax table. It gets even weirder with participation rules. SEPs must cover all employees who are 21 and 3 out of 5, meaning if the employee worked for the employer for 3 out of the last 5 years, they must be covered. Now, this is great if you have high employee turnover. It is not so good if you've got part-time college kids who work for you each summer. SEPs, they have no mandatory contribution and no substantial and recurring requirement. However, if you do contribute, you must contribute the same formula to everyone, and it vests 100% immediately. The last weird thing about SEPs is the self-employed individual. The max contribution amount needs to take into account your self-employment tax. It's a long calculation. You probably memorize that to max 25%, you contribute 18.59%, and for a 15% contribution, you contribute 12.12%. Next up, we've got simple IRAs. These live up to their names for being simple to set up and to administer. But there are trade-offs. First, they are only available to sole props with 100 or fewer employees. Next, like SEPs, all employer contributions vest 100% immediately. Now, as the employer, You are on the hook for mandatory matching, dollar for dollar up to 3%. Next, simple plans cannot be mixed up with other plans, which can be hard because the contribution limit on simples are much lower than other retirement accounts. See the tax tables. Finally, we've got simple 401ks. These have all the same features as the simple IRA, except that they are 401k. So they are ERISA qualified, meaning they have creditor protections unlike SEPs and simple IRAs. Now, since we've been talking about IRAs anyways, let's talk about normal IRAs. IRAs are individual, non-employer retirement savings vehicles. As such, anyone can contribute to an IRA up to the annual contribution limit on the tax table, but not everyone can deduct their contributions. If you or your employer contribute even $1 to an employer-provided retirement account, you are subject to income phase-outs. If your spouse is covered by an employer-provided plan, but you are not, you are subject to the spousal income phase-out. See the tax tables for these income limits. IRAs, they also have a catch-up contribution that kicks in at age 50. Another big aspect of IRAs and 401ks are RMDs. These kick in April 1 of the year following turning 73. You can still contribute to plans if you're working, so it's actually possible to be both contributing and withdrawing RMDs at the same time. One way to reduce RMDs is to make charitable donations straight from your accounts. QCDs can start at age 70 and a half. Another way to lower RMDs is to convert or save in a Roth account. Roths are post-tax savings, so the government kind of doesn't care when you withdraw funds, and they're not waiting for you to pay them income tax. Roth also has the feature that withdrawals are done on a FIFO basis. First, contributions come out, then rollover contributions, and finally, earnings. So, since contributions are always yours, this allows you to bypass penalties and income tax. Earnings, if withdrawn after 5 years of account opening and for a qualified purpose, like you're age 59 and a half, you're disabled, or for a one-time $10,000 first-time home purchase, these are also penalty-free. Otherwise, there is a 10% penalty. By the way, if clients are looking to withdraw retirement funds, it's helpful to remember a few ways they can do this. Rule of 55 for 401ks allows penalty-free withdrawal if a client leaves the employer at age 55 or later. Loans, these must be from your current employer plan if it allows. You can borrow up to 50% of your vested account balance, the maximum of $50,000, minus your highest outstanding loan balance from the past 12 months. Finally, you've got 72T, which allows the client to take substantially equal periodic payments before 59 and a half and avoid the 10% penalty. Now, this has got to go on for 5 years or until age 59 and a half, whichever is later. The amount withdrawn can be calculated using one of 3 methods. A client can make a one-time switch from the fixed amortization or fixed annuitization method to the variable RMD method. This is typically done if the account balance has decreased significantly due to a market downturn. By the way, inherited IRAs, they must be fully withdrawn within 10 years, unless the recipient is a surviving spouse, in which case they can hold the inherited IRA using their own lifetime timelines. Okay, we can go on and on about retirement accounts, but just a last few thoughts to wrap up this section. Non-qualified deferral compensation, NQDC, these plans are basically the answer for highly compensated employees. Nope, the employer cannot deduct benefits until the employee is taxed on the comp, but there are no caps and you can discriminate. In fact, that is the point, to allow highly compensated workers to discriminately defer their comp to hopefully a lower tax period in their lives. Equity comp, like ISOs and NSOs, they might show up on the exam. Remember, in alphabetical order, they go from most to least advantageous. So ISOs, NSOs, RSUs. ISOs are subject to AMT on exercise. On sale, if they are held for 2 years after grant and 1 year post-exercise, the spread between the exercise price and the sales price is subject to long-term capital gains with an AMT credit, if applicable. Now, if you don't meet the 2-1 requirement, then the exercise to fair market value at exercise is subject to income tax, And then the fair market value at exercise to sale is subject to capital gains, depending on the holding period. Finally, some qualified plans can purchase life insurance. These must be incidental, meaning the death benefit must be less than 100 times the expected monthly retirement benefit. Because life insurance premiums would be paid with pre-tax salaries, these are generally taxable to the employee. All right, we've moved on to insurance. We're going to cover auto, home, health, disability, and life insurance in about 10 minutes. Let's see. Now, insurance is about managing our exposure to risk. Remember, in the land of insurance, loss is the actual damage itself. Peril is the direct cause of the financial loss, and hazards are things that may increase the chances of peril and loss. In the case of personal auto policies, PAP, the losses are not just limited to your automobile. It includes Part A, liability coverage for damage done to other bodies or property for which the insured driver is deemed responsible. Part B, medical payments for the insured, their family, and others in the car. Part C, coverage for uninsured or underinsured motorists. And Part D, damage to the insured's car. This is broken out into collision, so hitting another car or an inanimate object, like a tree, and comprehensive, which is everything else. Theft, hitting an animal, falling objects. Policy coverage is often quoted in split limits, for example, 25, 50, 25. This is the maximum bodily injury coverage per person, the maximum bodily coverage per accident, and the maximum property damage coverage. All right, so let's talk about homeowners insurance. It covers much more than the home. You've got coverage A, the abode, the address, the house. Coverage B, the barn, so other structures on the property. Coverage C, your crap and other personal property. No, this coverage is fairly low, so if you've got fancy things like jewelry or things that require appraisals, you're going to want a separate policy or special endorsements. Coverage D, displacement, aka the hotel you stay at when you lose use of your home. Coverage E, exposure to negligence, so personal liability when someone slips on your snowy sidewalk. Coverage F, medical fees for others as a result of you, your premises, or animals, regardless if it's due to negligence or not. Policies will include provisions which define the perils covered. So these can be basic, which is a set of 12 named perils, broad, which adds an additional 6 perils, or open coverage, where all perils are covered except those expressly excluded. Now, perils that are not generally included in policies, they can be purchased separately or as a supplemental endorsement, such as earthquakes, sinkholes, sewage backups, and floods. Mapping to forms of homeowner insurance, we've got HO2, which offers broad coverage, HO3, open perils, HO4, renters, HO5, which extends open perils to personal property, making it the most comprehensive, HO6, condos, and HO8 for historic homes. So now that we know what's covered and what is not covered, how are losses valued and how much does insurance pay out? Well, there are 3 valuation methods. Replacement cost. This is the cost to replace or repair regardless of depreciation. This is typically used for the house coverage. Personal property. It's typically valued at actual cash value. So that does take into account depreciation. And finally, appraised or agreed upon value. That's used for things like collectibles. What the insurance company pays out, though, it's not the full value. To deter bad actors, there are coverage minimums, aka coinsurance, as well as deductibles. Now, coinsurance ensures that you are carrying enough coverage. Typically, it's 80% of the replacement value of the home. So if you are carrying less than that coinsurance minimum, then losses will be prorated. The insurance company pays out covered losses multiplied by that prorating factor, so the amount of coverage actually carried divided by the amount of coverage required minus your deductible. All right, let's shift gears a little and talk about health insurance. Similar to home insurance, there are deductibles and coinsurance. But in this case, coinsurance is cost sharing. Once the deductible is met, additional costs are split between the insurance company and the individual. For example, 80-20, individual or insurance individual, This goes on until the individual meets their out-of-pocket max. Once that happens, any excess expenses are covered entirely by the insurance company. Note, there can also be family-level deductibles. Now, health insurance is often offered as a group benefit by employers. This is tax advantaged to the employer, who can deduct premiums, and to the employee, who receive those benefits tax-free, or they can use pre-tax dollars themselves to pay the premium. For the self-employed, assuming that they do not receive coverage from another employer or through their spouses, premiums are taxable to the owner. However, this is offset by an above-the-line adjustment. By the way, if you lose your employer-provided health insurance, COBRA allows you to extend coverage for up to 18 months. Usually you have to cover the premiums yourselves. If you're disabled during this period, that coverage can extend to 29 months. And if coverage is due to the death of the worker, to divorce, the family can get up to 36 months of COBRA coverage, again, paying premiums themselves. All right, disability insurance. Rule of thumb is you want 60 to 70% of gross income covered. Insurers generally don't go higher due to the moral hazard it poses. Now, the definition of disability is a huge part of disability insurance, particularly long-term disability. Own occupation says you get paid if you cannot perform your specific type of job. Think surgeon, concert pianist. Any occupation, on the other hand, only pays out if you cannot do any occupation. So the surgeon can still teach and does not get an any occupation payout. There are hybrid definitions that might be own occupation for a few years and any occupation after that. Now, policies typically have elimination periods so that small things like minor illnesses do not trigger payouts. After the elimination period is satisfied, the payouts begin and continue for the benefit period. This could be as short as 2 years or as long as until retirement age. Taxation of disability benefits depends on who paid the premium. The general rule of thumb is, for all insurance payouts, if the premiums were paid with post-tax dollars, typically paid by the insured individual themselves, then benefits are tax-free. If premiums were paid with pre-tax dollars, like by the company or as part of a pre-tax cafeteria plan, then benefits are taxed. The taxman gets a share one way or another. Finally, life insurance. You have the insured, the owner, and the beneficiary. The owner has rights to assign benefits, the ability to access the plan's cash value, and receive dividends. If being used for estate planning, life insurance is often owned by someone other than the insured so that it's not included in the gross estate. This can be done when the policy is first written, or if the owner is the insured, the policy can be transferred to someone else before 3 years of the insured's death. Now, oftentimes this is done through an ILET. The trust holds ownership of the policy. The ILET can be funded at creation or through annual contributions that are made to the trust, with crummy provisions to make the funds eligible for the annual gift tax exclusion. Now, ILETs are great for clients who have excess cash that they don't need access to, and they want to grow that value tax-free by purchasing a large death benefit that then passes tax-free to their beneficiaries. In terms of the taxation of death benefits, well, as with disability, these are typically income tax-free if premiums are paid with post-tax dollars, and if paid with pre-tax dollars, say by the company who deducts the cost, then the death benefits are subject to income tax. Now let's talk about the different types of life insurance. Term insurance provides benefits for a defined period of time. After the term expires, coverage ends and there is no accumulated cash value. As a result, this is a type of pure insurance and has the lowest premiums. The term of the policy can be set for 1, 5, 10, 20, 30 years, making it possible to match the term of the duration to the client's risk exposure. So a 30-year mortgage or the 20-ish years before children become adults. The biggest con of term life is that coverage typically needs to be renewed at higher premiums. Whole life insurance is a permanent insurance, meaning coverage extends to death, assuming premiums are paid. There is a cash value element that acts like a savings mechanism, good for clients who may have a tendency to spend what they earn. These typically accumulate at a very low guaranteed interest rate. The cash value can be accessed during life via loans. Amounts up to the premium paid are tax-free, and amounts beyond that are taxed as ordinary income. Now, This is unless the policy is deemed a MEC. We'll talk about that in a minute. The biggest downside is the cost of whole life policies. Oftentimes, whole life has a level premium, so these are significantly higher than alternatives when the insured is younger. Next, we have universal life insurance. The idea of universal life was to manage the cons of whole life, namely the high premiums, while retaining the desirable qualities. Premiums are flexible because the accumulated cash value can be used to cover premiums. So a client could, for example, pay premiums for a decade, not pay while they're unemployed for a year or two, and then resume paying premiums, and the policy will still be enforced throughout. Taking cues, term life. Universal life can be written with a specific term or age, like retirement age, or it can be lifelong. All right, there is one more innovation that came out after universal life, and that is variable, whether that's variable whole life or variable universal. Now, previous policy types, they invested the cash value conservatively in a pooled account. Variable allows savvy clients to manage the investment of the cash value in a separate individual account. Now, I said we talk about MECs, so let's do that now. Wealthy people found a loophole by stashing money into the cash value part of their life insurance, using it as a tax-deferred investment vehicle rather than true insurance. Now, to deter this, the IRS created this idea of modified endowment contracts, MECs. If a life insurance policy is superfunded at any point during its first 7 years, meaning more premiums are paid than necessary, then it's deemed a MEC. You'll know it's a MEC on the exam because there will be a crazy first or second premium paid. Now, withdrawals on MECs, they are subject to a 10% penalty if done before age 59 and a half, and funds are treated in the opposite order. So first earnings are withdrawn with ordinary tax, and then withdrawals are treated as withdrawals of premiums. All right, I think we've hit the 60-minute mark. I was hoping to keep this review under an hour, but here we are. We still have tax and estate to go with a sprinkling of psych. So let's move on to tax. We're going to break tax up into Form 1040, the taxation of property, and finally gifting. Now, the general flow for calculating taxes is to follow the flow of Form 1040. Start with all income, W-2 income, portfolio income, passive income, everything, and take away adjustments for AGI, aka above the line adjustments. Common ones include pre-tax retirement contributions, pre-tax HSA savings, up to $2,500 in student loan interest, and self-employment business expenses like ordinary business expenses through Schedule C, contributions to self-employed retirement plans like Simples and SEPs, owner health insurance premiums, half of self-employment tax, QBI. Remember, you are considered self-employed if you have a sole prop, partnership, or LLC. Incorporated businesses, S Corps and C Corps, they do not count as self-employment. Plus, there are some niche above-the-line deductions like educator expenses and moving costs for military. Quick note about alimony and child support payments and income. For divorces finalized in 2019 and onwards, the person paying does not get to deduct them, and the person receiving does not have to include them in the income. For divorces finalized in 2018 or earlier, the opposite is true. The person paying is allowed to deduct, while the person receiving, they're the ones who pay the tax. Okay, so after AGI, which is the line, comes the below the line deductions. You can either take the standard deduction, which are listed on the tax tables, or you itemize on Schedule A. Common itemized deductions include mortgage interest, SALT, state and local taxes, losses from a presidentially declared disaster, medical expenses above the 7.5% of AGI, and charitable deductions. These are limited to 60%, 50%, or 30% of AGI, depending on the item donated. Now, if that item is cash, the limit is 60% of AGI. If it's a short-term capital asset or a tangible asset that is non-use related, then the value of the charitable donation is the lesser of the adjusted basis or the fair market value at donation. The resulting deduction is limited to 50% of AGI. Finally, long-term assets that are use-related, think painting to an art museum or stock. These are valued at fair market value. However, deductions are capped at 30% of AGI. Any excess can be carried forward. So with AGI minus deductions, you get income subject to federal income tax. This is multiplied by the marginal tax rates to get your liability. You then get credit for amounts already withheld, as well as estimated payments. Plus, there are some additional credits for old age, disability, college expenses, foreign taxes paid, earned income, childcare, and child tax credit. Only earned income credit is fully refundable. AOTC and the child tax credit are partially refundable. Remember, all things being equal, you would prefer a credit, a reduced tax liability dollar for dollar, then a above the line deduction, which can help you qualify for things with phase outs, and finally a below the line deduction. Now, if all things are not equal, then you're going to need to do some math using the income tax rate. Okay, now let's talk about property and taxes. The largest property for personal use is your home. $250,000 of gains on that property, double if married filed jointly, are excluded through Section 121. To qualify, you need to have owned and lived in the home for 2 of the last 5 years. This applies even in the case of QPRTs. Note, you can't claim losses on the sale of a primary residence. That's only possible for business income generating property. Now, there has been a lot of tax code written on business property transactions, whether that's real estate or personal property, stuff that can move out of real estate. We're going to talk about the full life cycle from income and losses while the property is in use to depreciation, in-kind exchange, and outright sale. Now, income from rental property, it is considered passive income. Limited partnership income, that's the other kind of passive income. Passive income is taxed at ordinary rates, but losses, they can't offset ordinary income. So passive losses need passive gains. A high earning investment banker can't just buy a quote income property to offset their W-2 income. By the way, that investment banker can only stay at his income property for 14 days or 10% of the days he rents it out for, whichever is greater, for that property to be considered a rental and to be able to deduct expenses. Among those deductible expenses is depreciation. This is the IRS's way to encourage investment by letting you get back some of your investment slowly, or not so slowly, over time. The fastest way is through Section 179, which lets SMBs deduct the full price of equipment or off-the-shelf software the year it was placed into service. This is up to $1.25 million. Generally, though, when you think about depreciation, you're probably thinking MACRS. This is an accelerated depreciation schedule, so faster than straight line, that follows a table put out by the IRS. Depending on the type of property, the number of years of depreciation varies. It's 5 years for cars and computers, 7 for office equipment and most other things, 27.5 for residential property, 39 for commercial property. Now, MACRS also specifies when to start claiming depreciation. For real property, it's mid-month. For personal property, it's mid-year, unless you place 40% or more of that equipment in Q4, in which case they ding you and you have to use mid-quarter. When you dispose of that property is subject to depreciation recapture, Section 1250 for real estate or 1245 for personal property like equipment. Now, real estate is subject to a 25% recapture tax rate. Personal property is subject to your ordinary income rate. So basically, depreciation was like the IRS giving you a free loan. Any gains above depreciation capture, they are subject to capital gains rate. And if the business property was disposed of at a loss, that loss is a deduction of ordinary income. This is the so-called best of both worlds, Section 1231. But what if instead of outright selling your business property, you exchanged it? 1031 like-kind exchange. Now, generally, when you see like-kind exchanges, you see it for real estate, but it can be used for life insurance as well. In real estate, the real gain is what you expect it to be. It's the value of the property you exchanged it for minus your adjusted basis. But what you need to recognize on your tax forms, that's different. The IRS is generous in this situation, and they require you to only recognize the lesser of the boot, aka the cash you got, or the real gain. This essentially lets you kick the tax can down the road. All right, let's take a hard left and talk about gifting. Gifting is when you give an asset to someone while you're alive. When it's done after death, it's called estate tax, and that is our next section. The IRS cares about gifting because, well, gift tax. Small amounts they don't actually care about. That is up to the annual gift exclusion, $19,000. It's on the tax forms. You can give your 10 children and their 10 children $19,000 each, tax-free each year. Double if you're gift splitting with your spouse. Plus, there are a few other exclusions like paying for tuition or paying for medical bills directly. If, however, you max out the annual gift amount, you still have a lifetime gift and estate credit, which allows you to transfer up to $13.99 million combined. So, for the purposes of the exam, gifts, when they are taxable, they are taxed at 40%, and the tax that is covered by the person giving the gift. To track all of this, there is Form 706. So if you're giving gifts above the annual exclusion, you've got to file that form and you need to include charitable gifts. However, if you don't have gifts higher than the annual exclusion, no form is needed, even if you have charitable gifts. Okay, so why gift? Well, beyond the obvious reasons, taxes. Income and future capital gains can be shifted from a higher tax bracket individual to a lower tax bracket individual. When you give something, say stock, the recipient keeps the original basis. This changes at death, by the way. A death bequest gets a step up in basis. Now, gifts, they also keep the original timeline. So it's more efficient to gift appreciated assets instead of gifting cash. Conversely, if you're in a high tax bracket, you're better off taking the loss and then gifting cash. And that's where we have our lookout, dual basis. When the gift is given at a loss, so the fair market value at time of gift is lower than the original basis, the IRS, they get suspicious. If the asset is eventually sold at a loss, the lower fair market value is used. If the asset is eventually sold at a gain, the higher original basis is used. And if the sale lands somewhere between the two, well, no gain and no losses are recognized. All right, we are about 15 minutes from being done. Let's talk about estate planning. So if gifting is about giving away property while you're alive, estate planning is about giving away assets after you die. The nice thing about gift and estate tax is that it is a unified system, meaning in some ways, the government doesn't care if you're giving away your possessions while you're alive or after you die. For example, the 13.99 in lifetime transfers, that covers both gifts and bequests. Similarly, the tax rate of 40% is the same. However, there are a few differences, namely step up in basis. Property and other assets acquired through bequests are received a step up basis, and gifts retain the original basis. All right, so let's talk a little bit about what happens when someone dies. First, we need to make sure that all the property is given to their new owners. Now, ideally, things go to where the deceased wished they were to go, generally laid out in their will. However, as you may know from family drama TV shows, wills can be contested, and the point of probate is to ensure the validity of the will and then dispense with the assets. This can take a while, and it can be expensive as state courts charge a fee for probate. That's why many wealthy individuals use substitutes to pass on assets. You may remember this using the acronym TLC. I remember it through the Better Journey. T for trusts, B for beneficiaries, like those on bank accounts, retirement accounts, and life insurance, and J for joint ownership, namely JTWROS and tenancy by entirety. These routes dispose of assets faster than probate. Now, we're going to talk about the different type of trusts in a few minutes, but let's finish up the estate tax process. While it's possible to have significant amounts of assets bypass probate, bypassing estate tax is harder. The gross estate includes the fair market value of everything the deceased owned or had an interest in at the time of their death. This includes things where they might not have been the outright owner, but they retained the ability to use the property, to determine who else got to use it or not use it, the ability to name a new beneficiary or name the trustee. The cleanest way to remove something like this from the gross estate is to give up these controls. However, some people try to retain control up until the last minute. The IRS, they have a rule about this. If control rights are released or given away within 3 years of death, those assets, well, they go back into the gross estate. Too bad. And if you try to gift away large amounts of assets within 3 years of death, the gift tax paid, that gets included back into the estate. not the gifts themselves, but the gift tax. So that's the gross estate. Now, like income tax, there are some above-the-line deductions to the gross estate. Unlike income tax, these tend to be not as substantial. They include things like paying off debt, like a mortgage, funeral costs, accrued tax payments, like what you owe to the government before you died, and costs to administer the estate. All of this, plus the final estate calculation, is reported on Form 709. 706 is for lifetime, 709 is for after you die. 709 must be filed 9 months after death. Okay, so now let's talk about trusts, the biggest tool for estate planning. A trust has a grantor, the person giving away the assets, a trustee, who legally administers the trust, and one or more beneficiaries. Most trusts are simple trusts, where all income passes through to the beneficiary. If a trust is complex and it retains income, that is taxed at a fairly high rate, which is included in the exam tax tables. Now, when a trust is created, it can be done in vivo, when the grantor is alive, or testament, after death. If a trust is created while the grantor is alive, the grantor can choose to make the trust revocable, so they have the ability to cancel or change it, or irrevocable. Upon death, revocable trusts become irrevocable. Now, if the grantor creates a revocable living trust where they themselves are the beneficiary, well, the IRS treats this essentially as if the trust did not exist. All income is taxed to the individual, and all assets are included in the gross estate. The benefit, though, of doing this living trust is that all assets, they bypass probate by virtue of being in a trust. By the way, testamentary trusts, those created after death, they do go through probate. That's because they're created through the will, the quote, last will and testament. Okay, so if a grantor wishes to exclude the assets from their gross estate and still have access to them during their lifetime, they could gamble and create a grantor retained trust. These trusts are set up with a term during which the grantor can receive benefits. They retain an interest in the asset. After the term is over, the asset reverts to the remainder men. Now, if the grantor dies during the term, the assets are included in the gross estate. They retained interest. If the grantor dies after the term, well, the assets have been given away. They are not included in the gross estate. GRATs, Grantor Annuity Trust, are a version of this. They provide a fixed annuity, that's the A part, to the grantor. GRUTs provide a set percentage of the trust's fair market value, and GRITs provide all the income, that's the I, to the grantor. GRITs are generally not used anymore, with the exception of the specialized QPRT, Qualified Primary Residence Trust. This places a home into a trust, freezing its value. The grantor retains the right to live in the property for a set period, after which the home, with its pros and value, transfers to the beneficiaries. This is great if you own a home in New York City or somewhere else where prices have skyrocketed. Now, another type of trust where the grantor may have retained interest are charitable remainder trusts. Here, the grantor places assets into a trust. The income is then given to a non-charity, which could be the grantor themselves or it could be someone else. After the set period, the remainder, like the name goes to the charity. Now, the charitable remainder trusts, they can pay out a fixed annuity, so that's a CRAT, or a fixed percentage of the trust fair market value, CRUT. These income payouts, they must be at least 5% of the trust assets and no more than 50%. Now, once again, if the grantor beneficiary dies during the term of the trust, the assets are included in their gross estate, though they're given a credit for the charitable remainder. And if the grantor beneficiary dies after the remainder, well, it's been given to charity, so there's nothing to include in the estate. Now, there are several other ways to give to charity. Obviously, there are outright gifts, like we talked about during tax planning. There are also pooled income funds. These are easier, more cost-effective, but less flexible to CRUTs. Here, the donor's contributions are pooled with other donors and managed by the charity. Income from the investments are then used to pay a lifetime income stream to the donor. Since the donor no longer has control over the assets, these are never included in the gross estate. All right, let's shift gears a little bit and let's talk about marital trusts. Now, the US tax code allows for unlimited transfers between spouses, whether that's gifts or passed through estates. This assumes, though, that the spouse is a US citizen. If they are not, the US spouse can only pass an additional $190,000 to their non US citizen spouse. QDOTs, qualified domestic trusts. These help mimic the unlimited marital deduction by creating a trust where the non US spouse is the beneficiary. The QDOT election must be made by the deceased estate executor. Now, if both spouses are citizens, they can use the unlimited marital deduction to leave large estates to each other. In a marital trust, also called Trust A, assets pass to the surviving spouse via the unlimited marital deduction. The surviving spouse owns the assets. They receive the income. They can access the principal. They name their own beneficiaries. And when that second spouse dies, estate tax is finally incurred. Now, where marital A trusts fail is when the total estate is quite larger than a single individual's lifetime gift and estate amount. That's where marital B trusts or bypass trusts were invented. Here, the first spouse who dies includes the assets in their estate, using up their own exemptions. The surviving spouse, they're still able to receive income from those assets, but often they have limited access to principal restricted to HEMS, health, education, maintenance, and support. Upon death of the second spouse, it bypasses their estate and goes to the ultimate beneficiaries named by that first deceased spouse. Bypass trusts, they're actually not as common anymore now that estate exemptions are portable between spouses. QTIPs are the other type of marital trust to keep in mind. QTIPs have two cottony ends, and QTIP trusts usually have two families. They want to make sure that funds pass on to the children from previous marriages. All right, we're running along here, so let's briefly touch on generation skipping transfer tax, GSTT, before wrapping up with business continuity. Now, GSTT stops the wealthy from bypassing a round of estate tax by transferring assets to the second generation. The important thing to remember here is how to identify a generation skip. When looking at transfers to family members, use the family tree. Skips are 2 or more generations away from the grantor. So, grandchild, grandniece, great-grandchild. If the transfer is to a non-family member, age is the deciding factor. A transfer to someone more than 37.5 years younger is considered a skip. Note, there is an equally large lifetime GSTT exemption amount. This is separate from the lifetime transfer, so the lifetime gift and estate is. Okay, business continuity. What do you do if you're a business owner who wants to pass on business assets? You've got a couple options. If you want the business to stay in the family and you need the income, consider a private annuity, installment note, self-canceling note, or grantor retained trust. Private annuities, here that senior business owner, they sell their business for an unsecured lifelong payment. Because it's usually sold at a fair market value, there's no gift tax and the asset is removed from their estate. Upon death, the payments end. Biggest cons, well, it's unsecured. And depending on the seller's health, the buyer could end up vastly overpaying or underpaying for the asset. Installment notes, they securitize the payment to the seller and they define a term. This is a gamble because, like grantor retained trust, if the seller dies during the term, the remainder payments are included in their estate. Which is how self-canceling installment notes came about. These have a clause that state that payments end upon the seller's death, removing that remainder from their estate. And finally, don't forget grantor retained trusts. We covered those earlier. Those are always also an option. Now, if the seller doesn't have needs for funds and is more focused on succession planning and estate planning, then consider family limited partnerships. Here, the senior family member retains 1% of the company, but maintains all the control. Junior family members are slowly gifted 99% of the restricted shares with no control. This keeps control of the business with the senior family member while keeping it away from individual family members' creditors. All right, final topic, psychology of financial planning. We're going to keep this one quick. A few biases to keep top of mind. Sunk cost fallacy, doubling down on an existing, usually losing investment because you're already too heavily invested in it. Confirmation bias, the tendency to search for information that confirms our existing opinion or interpret new information through the lens of our existing opinion. overconfidence, when we overestimate our capabilities and our chances of success. Now, questions about the financial planning process, they also crop up in this domain. Remember that if circumstances, such as a new job, a spouse passes away, happen, start back at step 1. Understand the circumstances. If the client looks distracted or they're uncomfortable while you're giving your recommendations, try to understand what else might be going on, even if it requires booking another meeting. And if you're presenting recommendations and the client disagrees, start by understanding their why, then compare and contrast the outcomes or tie it back to their goals. And if they give you instructions to do something other than your recommendation, well, you got to follow the instructions. And that's it. A not so fast, but also very fast review of all 8 domains of the CFP exam. Good luck in these next few days or hours. Remember, let yourself rest the night before the exam. Try not to study during the exam break. The course is set. The best thing you could do now is make sure that your brain and your body are performing at their best. If you haven't already, check out this video where I talk about the logistics of exam day so that nothing catches you off guard. Good luck and good rest.